In this section, we'll be discussing exponential moving averages and how to use them. Exponential moving averages, commonly referred to as EMAs in the trading community. The EMA lines act similarly to trendline support and resistance levels, and a combination of various EMA timeframes can be used by a trader to help them identify short-term trading opportunities in the context of larger timeframe trends. EMA stands for exponential moving average. It is a moving average indicator line that places more importance on recent price points. Like other moving averages that show a smooth line indication of a security's average price, the exponential moving average shows the average price over a specified amount of time, but places more importance on the more recent days, allowing it to be more responsive to new data. Rising EMAs can be used as confirmation of uptrending securities, and falling EMAs can help identify downtrending securities. Also, the interaction of the lines themselves, or crossovers, can be used as signals for entry or further confirmation of directional momentum. In this video, we're going to take a look at some of the lengths of the EMAs and their uses. The exponential moving averages are measured in days. Some of the most common EMA lengths are 8-day, 9-day, 20, 21-day, 50-day, and 200-day exponential moving average. The way they are calculated is to first take the average of the amount of days closing prices and then apply a multiplier or smoothing factor in order to give the EMAs a more reactive response to the more recent day's price action. The 8 and 9-day EMA are sometimes referred to as the short EMAs. They are the most responsive and reactive to price action and show the strength of the current trend momentum. They hug price action the closest and give a quick reaction to allow a trader to see a slowing of trend, a reversal, or even be used as a stop loss. These EMAs are also some of the weakest of the EMAs and do not put up much of a fight when acting as support or resistance. They're also the quickest to cross the other EMAs. Let's take a look at how the 8 and 9-day EMAs react on a chart when we're looking at price action. In this quick replay and review of price action on the S&P 500 E-mini 30-minute chart, we have both the 8 EMA in blue and the 9 EMA in yellow on our chart to see how they respond to the price action in this downtrend. As we could see here, as the EMAs went from strong downward momentum to becoming more flat, we notice that the price action has become flat as well, and the strength of the downtrend is not as strong while we sit on top of the EMAs. Let's see what happens as we progress further. Now that the price is crossing underneath the EMAs, we see that the downtrend is returning to its strength. Both the 8 and the 9 put up a decent fight for our quick downtrend move, and if we were short, we may also be able to use the 8 and 9 as a trailing stop loss in order to protect our profit. It is not until this candle here, with the close above both the 8 and 9 EMA, that we would know that the trend is slowing down and it's time to secure our profit in the trade. The 20 and 21-day EMA acts as more of an intermediate trend line. It is stronger than the short EMAs because it takes into account more days worth of data. It is relatively strong in the short term as both support and resistance. These longer EMAs show a flip in momentum when the line is reclaimed or broken. You could also combine other shorter EMAs with the 20 and 21 day EMA to act as an entry or exit signal for your trade. Let's take a look at some price action with the 20 and 21 day EMA on our chart. Just like the 8 and 9 EMA, the decision to use one over the other comes simply from experience with the chosen ticker you're choosing to trade and deciding which one through your back testing is more responsive for your intraday trading use. We'll now be looking at the use of the 20 and 21 day exponential moving average on our 30-minute chart for the S&P 500 E-mini. We'll see that the 20 and 21 EMA acts as more of an intermediate trend line that offers stronger resistance for our downtrend play and gives us a clear exit signal when it is broken that a reversal is about to occur. Let's see how this plays out on our chart. Now that we are short underneath the 20 and 21 day exponential moving average, we're comfortable and safe in profit in our trade, knowing that the strength of the trend is holding up. As the exponential moving average gets closer to the price action, we're on high alert to see if it's time to exit our trade in profit. Now that the 20 and 21 day exponential moving average has been broken, we can also suspect that the intermediate downtrend is broken as well, and the price will begin to cycle higher. The 50-day EMA can be viewed as the bounce line or the reversal line. It is the strongest of the short-term EMAs and acts as a very strong support or resistance for price action within an intermediate up or downtrend. Oftentimes when the 8, 9, 20, or 21 EMA are lost in containing price action, the 50 EMA will act as the last stand barrier before a total reversal of trend. Let's go back to our ES chart and see how the 50-day exponential moving average reacts with price action. Here we are back on our S&P 500 E-mini futures 30-minute chart with a 50-day exponential moving average on our chart. Suppose we are looking to enter a short position in a downtrend. We will see how the 50-day exponential moving average acts as a strong bounce line and contains the price in an intermediate downtrend when other EMAs may have been already lost. Here you can see when price interacts with the 50-day EMA, even during upwards price movement in a downtrend, the 50-day exponential moving average does a nice job of containing the price action and letting us know that the intermediate downtrend is still likely to continue. Depending on our strategy, we may be more likely to hold the position as long as it never breaks the 50-day exponential moving average. You can see over the course of many days that the 50-day exponential moving average does a nice job of holding the trend and letting the trader know that the downtrend is still continuing. To further illustrate the effect and strength of the 50-day exponential moving average, let's take a look at that same price action again, only this time we will have both our 8 and 20 exponential moving averages also on the chart. The 8 EMA is the blue line, the 20 EMA is the yellow line, and our 50-day EMA is still the red line. We could see that the shortest EMA is the quickest to react and hugs price the closest. The 20-day EMA shows the momentum of the intermediate trend, while the 50-day exponential moving average contains all of the price. You'll notice that even when the 8 and 20 EMA are lost, the 50-day exponential moving average still is capable of containing price and giving the trader confidence that the downtrend is still holding. We refer to it as the bounce line because when price action meets the 50-day exponential moving average, we often get large bounces as it rejects or accepts the 50-day exponential moving average. While using just the short EMAs, the trader may not have the confidence to stay in the trade as shorter EMAs are lost, but could add something like the 50-day exponential moving average to help them maintain confidence in the trend of their trade. Lastly, the 200-day EMA can be seen as the overall trend line or the swing trading line, wherein the price action behaves in one direction overall, either uptrending above the 200-day EMA or downtrending below the 200-day EMA. Some traders will base their strategy on only looking for longs above the 200-day EMA or only looking for shorts underneath the 200-day EMA. Let's go back to our ES chart and see how the 200-day EMA contains and behaves with price action. Here we are back on the S&P 500 E-minis futures chart on the 30-minute time frame with our 200-day EMA posted on the chart. Here we see, before even playing the replay function, that the start of our strong downtrend was signaled by a cross of the 200-day EMA. Let's see what happens with price action underneath the 200-day EMA. As you can see, for the most part, the price action has no problem staying underneath the 200-day EMA, which is a signal for a downtrend. Highly conservative traders looking to make sure that they are trading on the right side of the trend will typically only set their trading strategy in one direction that confirms with the 200-day EMA. For example, a trader may only be looking for short trades while the price action is being contained underneath the 200-day EMA.